Okay, let's unpack this. Have you ever felt like the global economy is just a series of incredibly complex dominoes, constantly tipping over? One fall in a distant country creating a ripple effect across continents.
Yeah, it certainly can feel that way sometimes, can it? It's remarkably interconnected.
It really is. Today, we're doing a deep dive into some of the most significant financial and fiscal crises of our recent past, starting right around 2008 and extending well into the last decade.
Mm-hmm.
Our mission for you, our listener,
Mm-hmm.
is to try and distill these incredibly complex financial events into, well, clear, actionable understanding. We want to bypass all that information overload you get bombarded with
Right.
and get straight to the core insights and maybe some surprising facts along the way. We've got comprehensive source material to guide us, a detailed overview of these recent upheavals.
And what's truly fascinating here, I think, is how interconnected these seemingly disparate events are. Even when they look like they're happening continents apart, they can end up impacting everything from, your pension fund to maybe even the cost of your morning coffee.
Absolutely.
We'll be looking at the genesis of these crises, starting with that unprecedented U.S. financial meltdown, then shifting to the Eurozone's sort of existential sovereign debt challenges, and even touching on the geopolitical ripple effects, like how all this eventually fed into something like Brexit.
Big stuff.
Yeah, big stuff. Our goal is really to help you connect the dots, understand not just what happened, but why it mattered back then, and maybe even more critically, why it still matters today in shaping, well, our current economic landscape and global policies.
So as we go through this deep dive, we really invite you, our listener, to consider what patterns start to emerge for you, what unexpected connections you might notice.
Definitely. It's about seeing that bigger picture.
Okay, so our journey into this era of, let's call it economic volatility, begins with the largest economy in the world, the United States. It went through two major crises in pretty quick succession, arguably the worst since the Great Depression of 1929 to 1933.
That's right.
First up, the financial sector crisis that just exploded in 2008.
Indeed. And the 2008 crisis was fundamentally a financial sector crisis. That means its roots lay deep within the private financial system, specifically, banks and the mortgage market.
Not government spending initially.
Not initially, no. Its origins, as our source vividly describes it, were deeply sown in what's called an inverted financial system. Now, to visualize this, try imagining an inverted pyramid balanced really precariously on its tip.
Okay.
That's how over-leveraged, how top-heavy this system had become. The sheer volume of financial products and debt resting on a comparatively tiny base of real assets made it incredibly unstable, just waiting to tip over.
An inverted pyramid that sounds incredibly dramatic and, frankly, unstable. Can you break down what that really means for our listener? How did these complex financial products and, crucially, largely unregulated trading create such a fragile system? What were the actual mechanisms at play?
Absolutely. That inverted pyramid concept really highlights a financial system where just an enormous amount of financial obligations and these highly complex instruments are built upon a relatively small base of actual, tangible assets, think real estate, productive businesses.
Got it.
The primary mechanism for this extreme overleveraging was through what are known as complex financial derivative products. Now, think of a derivative simply as a financial contract whose value is derived from something else, an underlying asset.
Like a stock or a commodity.
Exactly, or in this case, crucially, a mortgage. The critical issue, the danger, was that these derivatives were engineered with excessive, often hidden risk embedded within them. And very importantly, they were traded over the counter, or OTC.
OTCs. So not on a public exchange.
Precisely. Directly between two parties, rather than on regulated stock exchanges like the New York Stock Exchange. This lack of centralized exchange trading meant there was virtually no supervision, no real regulatory oversight.
So if they weren't traded on regulated exchanges, it means what? No transparent pricing, no central clearing. Essentially, nobody was really watching the shop while these incredibly risky things were being created and traded on a massive scale.
That's exactly it. The system just lacked transparency and accountability, and all of this was driven by a consumption-led growth model in the U.S., specifically fueled by a huge boom in housing loans. It became remarkably easy for individuals to get mortgage-backed loans.
The infamous subprime mortgages.
Including those, yes, often without stringent credit checks or substantial down payments. What then happened was that these seemingly simple mortgage loans were taken by financial institutions, and this is key. They were sliced and diced and repackaged into multiple, increasingly complex and inherently risky derivative products.
Sliced and diced. Sounds almost culinary.
Huh. Yeah, but much less appetizing. Think of products like collateralized debt obligations or CDOs. They bundled thousands of mortgages together, even those risky subprime ones given to borrowers with poor credit history.
Okay.
These CDOs were then further broken down, tranched, and sold off to investors all over the world. This whole process was so opaque, so layered with complexity, that it became incredibly difficult to differentiate the actual financial products from each other, or even to accurately assess who held which slice of the underlying risk.
So you could think you were investing in something relatively safe, like a highly rated bond, but buried deep inside it were these ticking time bombs, these risky mortgages.
Exactly right. The risk was obscured, hidden in plain sight almost.
Mm.
And this intricate web wasn't just confined to the US, not by a long shot. Our source highlights that it was a truly global financial architecture.
Oh, global.
Yeah, where banks, investment banks, pension funds, insurance funds, housing finance companies, hedge funds, they were all finely intermeshed with each other right across the world. And what's truly illuminating here, something the source points out, is that the globalization of the financial system, this deep integration of financial institutions, actually happened even earlier than broader economic globalization, like trade in goods.
That's interesting. Finance led the way.
It did. And it meant that once the cracks started to show in the U.S. housing market, the contagion effect was almost inevitable. It spread rapidly through this interconnected global financial network, hitting institutions and investors from Tokyo to London to Dubai.
And that led to things like Lehman Brothers collapsing.
Precisely. The failure of major institutions like Lehman Brothers and the necessary bailout of others like the insurance giant AIG really just demonstrated how systemic this risk could become. It threatened to bring down the entire global financial structure.
That paints a really vivid and, yeah, frankly, terrifying picture of how something seemingly small, like individual housing loans, could snowball into a global systemic risk, a crisis that seemed to just materialize overnight for many people. Now, here's where it gets really interesting and also quite perplexing, I think. Just a few years later, in 2011, the U.S. found itself grappling with a fundamentally different kind of crisis, a fiscal crisis. What's the critical distinction there, and how did something like a debt ceiling and this term fiscal cliff create such a unique and, let's face it, politically charged predicament for a country like the U.S.?
Yeah, this distinction is absolutely crucial for understanding the nuances of modern economic crises. You're right. The 2008 crisis was, as we discussed, a financial crisis centered in the private sector, banks, housing.
Right.
The 2011 crisis, however, was a fiscal crisis. That means it stemmed from the government's own balance sheet, its spending and its revenue, or rather, the stark imbalance between the two.
Government's books, basically.
Exactly. Our source attributes it to reckless fiscal spending over the past decade, which saw the deficit to GDP ratio, that's the gap between what the government spends and what it takes in relative to the size of the economy, climb to double digits in less than a decade.
But hang on, this spending wasn't entirely discretionary, was it? I mean, there were external pressures, especially after 2008, right?
Precisely. That's a really important clarification. While the phrase reckless spending can sound, pejorative, it's vital to understand the compulsions behind it. You had mounting Social Security expenditure driven by demographics, an aging population, rising healthcare costs that was already happening.
A structural issue.
A structural issue, yes. Then, boom, the 2008 financial crisis hits. It brings on a deep recession, some of the highest unemployment rates in U.S. history. And this absolutely necessitated a massive increase in government spending. Think unemployment benefits, food assistance, stimulus packages aimed at cushioning the blow for citizens and trying to stabilize the economy.
So crisis response spending.
Exactly. And alongside this, the Federal Reserve implemented policies of monetary easing, things like quantitative easing, which, while designed to stimulate the economy, also contributed to overall liquidity and, you could argue, indirectly eased the path for more spending.
Okay, so the government was spending significantly more to handle the recession's fallout and supported citizens, which seems understandable, necessary even. But what was happening on the other side of the ledger, the revenue side? Was that keeping pace?
And that's where the deeper problem really emerged. At the exact same time the government was dramatically expanding expenditure, tax rates were never truly reviewed or adjusted upwards to match these increased outlays. In fact, they remained virtually unchanged.
Unchanged, even with all that spending.
Or even worse, paradoxically, as a direct response to the 2008 crisis, tax rates were actually lowered in some areas, primarily through extensions of the Bush-era tax cuts. The idea was to boost consumption, put more money in people's pockets, and hopefully revive growth.
Ah, classic stimulus debate. Cut taxes or increase spending.
Right. But the result of this combination, dramatically increased spending and static or even lowered tax revenues, was a rapidly expanding budget deficit. And that inevitably led to a mounting national debt.
Okay, so the debt is piling up. When did it hit crisis point? What was the trigger?
The trigger, the specific crisis point, arrived when the U.S. hit its overall debt ceiling. The source mentions USD 16.4 trillion at that time. Now, the debt ceiling is a legislative limit set by Congress on the total amount of national debt the U.S. Treasury can incur.
A self-imposed limit.
A self-imposed and often politically weaponized limit.
Right.
Once that ceiling is reached, the government literally cannot borrow any more money to meet its existing legal obligations. Things like paying federal employees' salaries, Social Security benefits, or crucially, even paying interest on its existing bonds.
Oh, it couldn't pay its bills.
Potentially, yes. It meant the deficit could no longer be sustained through increased borrowing, which had been the standard practice for decades. Fears of actually breaching this cap led to the very real, unthinkable likelihood of a default on its debt. The government wouldn't be able to meet its bond payments unless it raised more debt, which the cap legally prevented it from doing.
Defaulting on U.S. debt. That sounds catastrophic.
It would be. The situation was so grave, so unprecedented for the world's benchmark economy, that it resulted in the first ever downgrade of the U.S. government's credit rating by Standard & Poor's back in 2010. S&P basically said, "We don't have as much faith in your ability to manage your finances anymore."
Wow. For the U.S., whose bonds are seen as the safest asset globally, that's huge, a massive signal.
A truly seismic event, yeah. It signaled a loss of faith in U.S. fiscal management and immediately raised the potential cost of future borrowing.
Okay, so a credit downgrade for the United States, the ultimate global safe haven, an unprecedented moment that must have sent shockwaves. And then we hear about this fiscal cliff looming. What exactly was that? How did that play out?
Right, the fiscal cliff. The Senate, recognizing the extreme gravity of the situation and the potential for a global financial chaos if the U.S. defaulted, eventually passed a resolution to suspend the debt cap to raise it temporarily.
A last-minute deal.
Often is. But this reprieve came with very strict conditions attached. It mandated significant austerity measures cuts in future government spending. And crucially, the automatic rollback of certain tax concessions, the Bush-era cuts primarily, effective December 2012.
Automatic.
Automatic unless Congress acted to change it. This impending combination of drastic spending cuts and significant tax increases, set to happen simultaneously and automatically, created what was dramatically termed the fiscal cliff.
Like driving towards the edge.
Exactly. The term vividly highlighted the government's relative inability, politically mostly, to both reduce spending and raise taxes significantly, especially when you still had stubbornly high unemployment rates and only marginal economic growth. It was a politically imposed dilemma: impose austerity and potentially choke off the recovery, or let the debt continue to balloon.
What was the outcome? Did they go over the cliff?
They reached a last-minute deal, as often happens in these situations, to avoid the worst aspects of the cliff, but the underlying pressure remained. The government was effectively compelled to agree to cut expenditure by an enormous USD 1.2 trillion over a 9-year period, starting in December 2012. This was a forced reduction in future spending, known as sequestration in some cases, intended to rein in the debt over the longer term.
1.2 trillion over 9 years. That's a big number.
It is. And what's particularly unsettling about this, as our source points out quite starkly, is that this fiscal crisis has not been resolved but only postponed.
Postponed.
Not solved.
That's what the analysis suggests. It explicitly states that the fiscal cliff would resurface soon, implying that the underlying structural issues, that fundamental gap between government commitments, especially on things like healthcare and pensions, and its revenue stream, they remain largely unaddressed.
So it raises an important question for all of us, really. Are these just temporary fixes, sticking plasters, or is the U.S. facing a kind of perpetual struggle with its fiscal balance, just waiting to rear its head again?
That's the lingering question, absolutely. It suggests a vulnerability that hasn't gone away.
Okay, so we've navigated the storm of 2008, the financial crisis, and the fiscal cliff drama of 2011. While the source suggests the fiscal issues are merely postponed, which is sobering, what signs of economic life, if any, emerged from all this turmoil? Was there any kind of silver lining?
There was, and arguably still is, a tangible silver lining beginning to emerge for the U.S. economy, signaling a path towards, well, revival. A key indicator of this improving economic health is the Federal Reserve considering withdrawing quantitative easing, or QE.
QE again. Remind us briefly what that is.
Sure. To put it simply, QE is when a central bank, like the Fed, essentially creates new money electronically to buy large quantities of government bonds or other financial assets from commercial banks.
Injecting money into the system.
Exactly. The goal is to inject liquidity, push down long-term interest rates, and encourage banks to lend more, businesses to invest, hopefully stimulating economic growth during a downturn. So when the Fed considers withdrawing QE or tapering its purchases, it means they are considering stopping these injections of liquidity.
They think the patient doesn't need as much medicine.
That's a good analogy, yeah. It's a significant sign of an economic recovery because it implies the central bank believes the economy is becoming strong enough to stand on its own 2 feet without needing that constant monetary stimulus.
So less need for financial life support. That definitely sounds promising. But even with these positive indicators, there's always this concern, this phrase you hear, double dip recession. What does that actually mean? What are the implications for the average person?
Indeed, less need for life support is a good way to put it. But you're right, the recovery path is rarely smooth. Despite those positive signs, it's difficult to say with certainty at any given stage whether it truly marks the end of the downturn or if there might be a double dip recession. Meaning a second period of economic contraction, a second recession occurring before the economy has fully recovered from the first one, like falling back down after starting to climb out of a hole.
Okay, that makes sense.
Economic recovery is rarely a straight line, and there's always an element of uncertainty, unforeseen shocks. For the average person, a double-dip recession would unfortunately mean another period of economic pain, potentially renewed job losses, falling incomes, businesses struggling, and banks possibly tightening credit again.
So it really underscores the idea that even as things improve, economic stability isn't guaranteed. It's a continuous challenge.
Absolutely. Requires vigilance, careful policy management, and maybe a bit of luck, too.
Right. Now let's shift continents. Because while the U.S. was dealing with its own crises, over in Europe, a completely different yet equally profound kind of crisis was brewing. And this one, as you mentioned earlier, was deeply rooted in the very structure of its ambitious monetary union. And that makes it really unique compared to the U.S. experience, doesn't it?
Yes, absolutely. The Eurozone crisis offers a stark and in many ways even more complex contrast to what happened in the US. It really highlights the unique challenges inherent in trying to run a single monetary policy across many diverse national economies.
So before the crisis hit, how was this Eurozone set up? It wasn't always a single currency zone.
Yeah, no, exactly. Historically, the European Union first developed primarily as a single economic market, an economic union focused on facilitating free trade of goods, services, capital, and labor among its members. That was already a huge achievement.
Common market.
The common market, yes. But the Eurozone itself, the monetary union part, came into existence much later with the signing of the Maastricht Treaty back in 1992. This marked a far more ambitious, some would say audacious step. The creation of a monetary union with one central bank, the European Central Bank, or ECB, and eventually a single currency.
The euro. It truly sounds like a grand, almost unprecedented experiment, doesn't it? Creating one currency for so many historically distinct nations. But it seems, even from the very beginning, there were some incredibly complex, maybe even inherent dynamics that sort of set the stage for future problems, correct?
Absolutely. The ambition was huge, but the foundations had potential weaknesses from day one. The euro, as the common currency, officially came into existence in 2002, replacing numerous iconic national currencies, the Deutsche Mark in Germany, the French franc, the Italian lira, and so on.
A big symbolic and practical change.
Huge. However, this adoption was far from uniform across the EU, which is a really critical point to grasp. Out of the then 27 member countries of the broader European Union, only 17 initially chose to accept the euro as their common currency, and formally became part of the Eurozone, subject to its rules.
And only 17. Who stayed out?
Well, 10 members, including significant economies like the UK, Sweden, and Denmark, plus others, did not opt for the euro. While they accepted the euro as a valid currency for trade and transactions, they explicitly retained their own respective national currencies, the pound sterling, the krona, and remained outside the formal eurozone structure, even though they were full EU members.
So you could be in the EU, but not use the euro.
Correct. And what's even more nuanced, adding another layer of complexity, is that there are 6 other countries or territories, like Montenegro or Kosovo, that actually use the euro as their de facto currency, but are not part of the eurozone proper, mainly because they aren't even EU members.
That sounds complicated.
It is. It means that in total, something like 23 countries in the world use the euro as their currency, but only the core group 17 at the time of this crisis, now 19, are actually bound by the eurozone's specific rules, its monetary policy set by the ECB, and its governance structures.
So this complex, almost patchwork nature right from the start, it highlighted this intricate, non-uniform attempt at monetary integration, a union bound by a single currency, but critically, without a fully unified fiscal policy. No common treasury.
Exactly, that's the crux of it. A monetary union without a fiscal union. And this structure, or lack thereof, created vulnerabilities.
This raises an important, maybe even existential question then. It sounds like the Eurozone was built on some inherently shaky foundations from a structural point of view. How did these fundamental differences among member states really set the stage for such a deep-seated crisis, particularly concerning that growth with stability pact you mentioned? What was that?
You're right to focus on the structural issues. What's truly fascinating and ultimately proved deeply problematic is that the Eurozone arguably had these structural problems baked in right from its inception. We can really identify 4 key issues that compounded over time, setting the stage for what became the sovereign debt crisis.
Okay, what's the first one?
Firstly, it was a union of vastly dissimilar economies. Just fundamentally different. We're talking about countries with enormous differences in size. Think Germany versus Malta. Differences in the nature of their economic activities, industrial powerhouses versus tourism-dependent nations. Differences in resource endowments, technological advancement, and crucially, levels of development and average incomes.
So Germany and France on one side, and then?
Exactly. On one hand, you had the industrial powerhouses, the export-driven economies like Germany, the Netherlands, Finland, France to an extent. On the other hand, you had what became known as the peripheral economies, think Greece, Portugal, Spain, Ireland, even Italy to some degree, often more reliant on tourism, construction, agriculture, or lower value services, with perhaps less developed industrial bases or lower productivity growth.
And trying to manage those with one policy.
Imagine trying to set one single interest rate, dictated by the ECB in Frankfurt, that works perfectly for both a fast-growing, export-oriented powerhouse like Germany, worried about inflation, and a slower-growing, highly indebted, maybe housing bubble-prone economy like Spain or Ireland needing stimulus. It's incredibly challenging. One size doesn't fit all. A policy suitable for one might be actively harmful to another.
Okay, that makes sense. Dissimilar economies. What's the second structural issue?
Secondly, the monetary union wasn't formed across countries with similar monetary strengths historically. Before the euro, some members, like Germany with its super-strong Deutschmark or the Netherlands with its guilder, had currencies that were often seen as safe havens, reflecting decades of fiscal prudence and low inflation.
Rock-solid currencies.
Pretty much. Conversely, others, such as Greece with its drachma, Portugal with its escudo, or Spain with its peseta, had histories of weaker currencies, often prone to depreciation due to higher inflation, persistent trade deficits, or less fiscal discipline.
So putting them all in the same currency bed.
Exactly. Bringing all these disparate monetary strengths under a single strong currency like the euro, which inherited much of the credibility of the Deutschmark without fully addressing the underlying economic divergences, well, it amplified existing imbalances. Weaker economies suddenly found their borrowing costs significantly reduced. Why? Because lenders now perceived them to have the implicit backing of stronger Eurozone members like Germany, even though their underlying economic fundamentals hadn't magically improved overnight.
So they could borrow cheaply, maybe too cheaply.
Precisely. It fueled unsustainable borrowing booms, particularly in housing and government spending in several of these peripheral countries.
Okay, number 3.
Thirdly, there were persistent, large current account imbalances within the Eurozone. The larger, more competitive economies, particularly Germany, consistently ran substantial current account surpluses. They exported significantly more goods and services than they imported, accumulating claims on the rest of the world, including other Eurozone countries.
I'm the others.
Many of the peripheral economies, conversely, ran persistent current account deficits, often largely with Germany and other core Eurozone countries. They were buying more than they were selling internationally. This illustrated a fundamental, growing divergence in economic performance and competitiveness within the single currency area.
And without their own currency, they couldn't just devalue to fix that imbalance.
Exactly. That's the key constraint of a currency union. Normally, a country running a large deficit might see its currency weaken, making its exports cheaper and imports more expensive, helping to rebalance things. But inside the Eurozone, that wasn't possible. Instead, these deficit countries had to rely on painful internal devaluation, basically, trying to cut wages and prices relative to their neighbors to regain competitiveness. That's incredibly difficult, slow, and politically toxic.
Leads to austerity and social unrest.
Often, yes. And finally, the fourth critical structural flaw was the failure of the Growth with Stability Pact. Now, this pact sounded good on paper. It was an understanding, a set of fiscal rules agreed upon by Eurozone members intended to ensure fiscal discipline.
What were the rules?
The main rules were government debt should not exceed 60% of GDP, and the annual budget deficit should not exceed 3% of GDP. Simple enough benchmarks.
Seems reasonable. So what went wrong?
The problem, as our source explicitly states, is that this pact was never adhered to by the member countries with any real consistency or discipline. Even large countries like Germany and France breached the deficit limits early on.
Why not? No teeth.
Largely, yes. It stemmed from political expediency, governments wanting to spend before elections differing national priorities, and crucially, a lack of strong, credible enforcement mechanisms. There was no central Eurozone treasury to really impose penalties or bail out struggling members cleanly. This allowed countries, almost encouraged them, to engage in fiscal excesses and accumulate persistently high levels of deficits and debt, often hidden through accounting tricks in some cases.
And this led to...
This resulted in massive borrowings, especially by those countries that became colloquially known, rather unkindly, as the pigs economies: Portugal, Ireland, Greece, and Spain. Because there were no real enforcement mechanisms and no common fiscal backstop, countries were able to accumulate this excessive debt, much of it owed externally. This directly led to the Eurozone crisis, which is fundamentally a sovereign debt crisis.
Sovereign debt, meaning government debt, owed to folks outside the country.
Primarily, yes. Government debt owed often to foreign banks, international investors, or later international institutions. This made it an international problem with potentially global contagion effects, especially through the highly interconnected European banking system.
So with those deeply ingrained structural issues, dissimilar economies, borrowing imbalances, no real enforcement, it's perhaps, in hindsight, no surprise that some countries eventually became flashpoints, really testing the very fabric of the Eurozone.
Exactly. The underlying tensions were bound to surface eventually.
Let's zoom in on two particular cases that vividly highlighted this interconnectedness and fragility. They show just how quickly a national problem could morph into a regional, even a global threat. Cyprus and, of course, Greece.
Yes, these two really brought the crisis to a head. The crisis in Cyprus, which peaked around 2013, was a classic banking sector crisis, as the source calls it. It bore a striking resemblance, actually, albeit on a much smaller scale, to the global events of 2008.
A banking crisis again. What was the core issue there?
The core issue was that the sheer volume of banking business in Cyprus was many multiple of its GDP, its actual national economic output. It had positioned itself as an offshore financial center, attracting huge deposits, particularly from Russia. This created an enormous and critically largely unregulated financial sector that was just disproportionately large compared to the country's real economy.
So the banks were way bigger than the country could support if things went wrong.
Precisely. It made the whole system incredibly vulnerable to shocks.
This sounds almost like a microcosm of 2008, like you said, but contained within a smaller economy. What made Cyprus so uniquely vulnerable then? And especially, what was the link to Greek bonds you mentioned? How did those interdependencies play out?
Yeah, you've hit on the key point there. It's high exposure to Greek bonds. The Cypriot banking sector, seeking higher returns, had invested very heavily in Greek government bonds. At the time, these seemed relatively safe because, well, Greece was a fellow Eurozone member.
Yeah.
Supposedly backed by the might of the euro.
Uh-oh. Famous last words.
Pretty much. When the Greek debt crisis deepened dramatically and it looked like Greece might default or restructure its debt, the value of those Greek bonds held by Cypriot banks plummeted. This caused massive, crippling losses for the Cypriot banks.
So the Greek problem directly infected Cyprus.
Directly. This severe exposure, combined with the unregulated nature and the sheer oversized scale of its banking sector relative to its small economy, almost resulted in the complete collapse of Cyprus's second largest bank, Laiki Bank, and threatened the entire financial system. This direct contagion link via bond exposure vividly demonstrated how deeply interconnected these financial systems are and how crises can transmit rapidly, even from one relatively small periphery economy to another.
What happened? How was it resolved?
Well, to prevent a complete meltdown that would undoubtedly have had wider, unpredictable Eurozone implications, a bailout became absolutely necessary. It was orchestrated by the European Central Bank, the European Commission, and the IMF, the group often referred to as the Troika.
Another bailout.
Yes, but this one was particularly controversial because it involved a bail-in of depositors. This meant that even large depositors in the failing banks, those with deposits over the guaranteed limit of 100,000 euros, saw a portion of their savings forcibly converted into bank equity or written off entirely to help recapitalize the banks.
Wow, so savers lost money, not just investors.
Savers with large deposits, yes. It was a shock to the system and set a very difficult precedent, raising serious questions about deposit safety and trust in the Eurozone's banking system going forward.
The Cyprus crisis, though maybe smaller in overall scale than Greece, certainly sent shivers through the Eurozone.
Yeah.
A real wake-up call about bank resolution. But the story of Greece, that's perhaps the most prominent, the most protracted, and maybe the most painful episode of the whole Eurozone crisis.
It really is.
This is where I think the human cost of these large-scale economic decisions, these austerity measures, really comes into sharp focus. Greece's story is one of just painful contraction, immense external pressure, and ultimately a real test of national resilience. How did a national budget deficit spiral so dramatically into such an existential threat to the entire Eurozone project?
You're right. The Greek debt crisis truly exemplifies the dangers lurking within a monetary union that lacks a unified fiscal policy. It started, fundamentally, with what our source describes accurately as a dangerous amount of sovereign debt owed by the Greek government. This wasn't just from one or two bad years. It had largely accumulated over decades due to a combination of factors: historically poor tax collection, overly generous public spending commitments, particularly in pensions, and a persistent lack of fiscal discipline across different governments.
So underlying problems were there for a while.
They were simmering. But the situation became acutely hazardous, explosive, really, when in late 2009, the newly elected Greek government under George Papandreou made a shocking revelation. They announced that previous governments had systematically misreported the country's fiscal data for years. The budget deficit for 2009 wasn't the relatively manageable 6% of GDP previously reported, but a staggering 12.9% of GDP.
Double. More than double. And way over the EU limit.
More than 4 times the EU's supposed limit of 3% under the Stability Pact. This sudden, dramatic revelation of the true dire state of Greece's public finances sent absolute shockwaves through financial markets globally.
I can imagine. What happened next? Did the markets panic?
They did. Reputable credit rating agencies, Fitch, Moody's, Standard & Poor's, acted swiftly, dramatically lowering Greece's credit ratings one after another. They essentially flagged Greece as a much riskier bet for investors.
Raising a huge red flag.
A massive red flag. This, in turn, scared off private investors. Suddenly, it became incredibly difficult, then prohibitively expensive, and finally, virtually impossible for Greece to borrow new money from international capital markets. And they needed to borrow constantly, not just for new spending, but to roll over their existing debt as it matured.
So they were cut off from funding.
Essentially, yes. Greece found itself in a terrifying situation where it couldn't find the funds to repay its existing debt obligations as they came due. This pushed the country right to the brink of a sovereign default.
And default within the Eurozone was unthinkable.
At the time, yes. Since 2008, even before the full extent of Greece's specific woes became clear with that deficit revision, EU leaders had been struggling, often behind closed doors, to agree on a coherent and sustainable solution for managing potential crises within the Eurozone. This process, particularly when focused on Greece, highlighted deep divisions, conflicting national interests, and fundamental policy disagreements within the Union.
Like the North versus South divide. Fiscal hawks versus doves.
Very much so. Particularly between countries emphasizing fiscal discipline and adherence to rules, like Germany and the Netherlands, and those, perhaps including France and Southern European nations, advocating for more solidarity, burden sharing, and maybe even some form of debt relief or mutualization.
And while they argued, Greece suffered.
Profoundly. During this agonizing period of negotiations, bailouts, and imposed austerity, the Greek economy literally shrank by a staggering 25%. A quarter of its economic output vanished. Its debt-to-GDP ratio, The total government debt compared to the size of its shrinking economy ballooned to an almost unimaginable 179%. Repayment seemed mathematically impossible under those
How
conditions.
could they possibly pay that back?
That was the central question. A major point of disagreement was the burden sharing who would ultimately bear the losses. Would it be Greek taxpayers through endless austerity, German and other European taxpayers through bailouts, private bondholders through debt write-downs, haircuts? Greece, understandably, argued strongly for significant debt forgiveness or at least substantial reprofiling to make its burden manageable and allow for some hope of recovery.
And the numbers involved in just keeping Greece afloat were just staggering, weren't they? How much did other European authorities and private investors eventually have to loan Greece? And how much of that has actually been repaid?
The scale of the financial intervention was indeed enormous, unprecedented for a single country rescue. Our source indicates that since February 2015 alone, following earlier packages, various European authorities, primarily through newly created rescue funds like the European Financial Stability Facility, EFSF, and later the European Stability Mechanism, ESM, along with the IMF and some residual private involvement, collectively loaned Greece approximately $294.7 billion euros.
Almost 300 billion euros.
Just staggering sums. Yet, as our source highlights, by the time of its writing, Greece had only managed to repay a mere 41.6 billion euros of that vast sum. It just demonstrates the immense, almost crushing weight of its debt burden, even after multiple restructuring efforts.
And this wasn't just a Greek problem, was it? It threatened the whole system.
Absolutely not. This wasn't just about one small country on the periphery. It triggered the broader Eurozone debt crisis, spreading fear to Ireland, Portugal, Spain, even Italy and Cyprus. It created genuine fears of a Lehman-style global financial crisis, originating this time from sovereign debt rather than private mortgages. And most critically, it threw into question the very viability, the long-term sustainability of the Eurozone project itself. Could it survive a member defaulting or leaving?
Yeah, Brexit fear.
The Grexit fear, exactly. It served as a stark, terrifying warning of what could potentially happen to other heavily indebted EU members. Ultimately, the prevailing view among core EU leaders was that they had no choice but to stand behind its member, however reluctantly, to avoid the catastrophic, unpredictable consequences of Greece either leaving the Eurozone or defaulting on its debt entirely. Either scenario could have triggered bank runs, market panic, and unimaginable ripple effects across the highly integrated European banking system and global financial markets.
So the emergency funds came, the bailouts happened, but they came with extremely strict conditions attached. These infamous austerity measures. They had profound, incredibly painful impacts on everyday life for ordinary Greeks, didn't they? Can you detail some of those specific measures and their real societal impact?
They absolutely did, and the human cost was just immense, stretching over many years. The EU and the International Monetary Fund, the Troika, provided those huge sums, 240 billion euros in the main programs. But this aid came in return for extremely stringent, deeply intrusive austerity measures. These demanded a fundamental, painful overhaul not just of Greek public finances, but of its entire society and economy.
What kind of things specific?
Specifically, these measures required Greece to implement a whole raft of policies, including raising taxes significantly. This included hikes in the VAT, value-added tax, on goods and services, making everyday items more expensive, and increases in corporate tax rates, cracking down on tax evasion. They had to intensify efforts to close loopholes and reduce Greece's chronic problem of tax evasion, though success was often limited. Pension reforms. This was a huge word. They had to reduce incentives for early retirement, effectively increasing the retirement age for many, and raise worker contributions to the pension system while also cutting actual pension payouts. This hit elderly citizens and those nearing retirement incredibly hard. Public sector cuts. There were significant cuts to public sector wages, hiring freezes, and layoffs, leading to widespread unemployment among state workers and a noticeable reduction in the quality and availability of public services. Privatization. And perhaps one of the most significant and ideologically charged changes was the mandated privatization of many state-owned Greek businesses. This included critical public infrastructure, like the main electricity transmission grid operator ADME, major ports like Piraeus, regional airports, and other state assets.
Selling off the family silver, essentially.
That's how many Greeks saw it. The explicit aim, stated by the creditors, was often not just to raise revenue, but also to reduce the perceived power of socialist-leaning parties and public sector unions, which had historically held considerable sway in the country and were often seen by the Troika as impediments to structural reform. This deeply affected social welfare provision, job security, and national sovereignty concerns.
And this pressure didn't just stop after the initial bailouts, right? It continued for years.
No, it was relentless. Even years later, the pressure continued unabated. As late as January 15th, 2018, the Greek parliament was forced to agree on yet more new austerity measures just to qualify for the next tranche, the next payment of bailout funds.
Still squeezing in 2018.
Yes. And just a week later, on January 22, Eurozone finance ministers were expected to approve an additional 6 to 7 billion euros based on these new commitments. These newer measures were arguably even more granular, more intrusive in their impact on daily life. For instance, they made it significantly more difficult for unions to call strikes a critical point, as the country had often been paralyzed by general strikes protesting the very austerity being imposed. They also included measures aimed at helping Greek banks finally reduce their crippling load of non-performing loans, bad debt, further opening up previously protected markets like energy and pharmacies to more competition, and even recalculating child benefits. It really reflected the far-reaching, deeply personal impact of these external demands on the lives of ordinary Greek citizens.
When did the official bailout program finally end?
The third and final bailout program was officially scheduled to end, and did end, in August 2018. However, it's crucial to understand that this didn't mean Greece was suddenly free and clear. The path to recovery for Greece is still incredibly long, demonstrating the potentially generational impact of these types of crises and their resolution.
So even after the bailouts ended, the oversight continued.
Yes. While there have been undeniable signs of improvement, the unemployment rate, which peaked above 25%, eventually fell back towards 20%, still incredibly high, but an improvement. And the economy, after shrinking by that catastrophic 25%, did return to modest growth, around 2.5% in some years compared to the near 10% contraction in 2011. The country still faces enormous challenges. Greece still expects, under the agreements, to be repaying its massive debt load until at least 2060.
2060. Decades more.
Decades. And until then, European creditors, through mechanisms like enhanced surveillance, will continue to closely supervise Greece's adherence to fiscal targets and the reform commitments made under the bailout programs. The Greek crisis truly tested the very viability of the single currency experiment. It starkly showed the immense economic and political strains that can arise from deep economic divergences within a supposedly unified monetary system that lacks a corresponding fiscal union and robust solidarity mechanisms. It set a difficult precedent for how much economic and political sovereignty a nation might have to cede in times of crisis when locked within such a union.
Fascinating and deeply sobering indeed. The Greek crisis definitely exposed the fundamental fault lines within the Eurozone structure. Now, let's turn our attention finally to another significant event. One that, while perhaps distinct from the immediate financial and fiscal crises we've just discussed in detail, certainly sent its own powerful ripples across the globe and was, I think we can agree, undeniably influenced by the continent's broader economic and political climate over the preceding decade.
We are talking, of course, about Brexit. That widely recognized abbreviation, simply standing for British exit, refers to the United Kingdom's momentous decision, via a referendum in June 2016, to leave the European Union after more than 40 years of membership.
Right. And Brexit was a different kind of economic tremor, wasn't it? It wasn't driven by a financial collapse like 2008, or a fiscal imbalance hitting a debt ceiling like the U.S. in 2011, or even a sovereign debt crisis like Greece. This was driven primarily by political will, by a popular vote. So what made its immediate impact so significant on global markets, especially given it originated as a political event rather than a purely economic one?
That's a great question. What made Brexit's immediate impact so significant, so jarring for markets, was precisely that it defied expectations, as our source material puts it. Leading up to that June 2016 referendum, most financial markets, most economists, pollsters, and political analysts had confidently predicted, perhaps complacently, a Remain vote. The general assumption was that the economic arguments for staying within the EU's single market would ultimately prevail over the political arguments for leaving.
So the markets were caught off guard.
Completely. The leave decision came as a substantial, almost unthinkable surprise to many participants in the global financial system. This unexpected outcome, this political shock, immediately roiled global markets. That means it caused significant instability, volatility, widespread uncertainty, and a classic flight to safety among investors.
How did that manifest itself? What were the immediate signs?
A key, immediate, and very visible indicator of this shock was the British pound sterling. It fell dramatically, almost instantaneously, against the US dollar and other major currencies, hitting its lowest level against the dollar in over 30 years. That's a truly historic depreciation for a major global currency.
Wow, a 30-year low overnight. What did that signal?
It reflected widespread investor apprehension about the UK's economic future outside the European Union. There were immediate concerns about potential new trade barriers with its largest trading partner, reduced access for UK businesses, especially financial services, to the EU single market, and just the massive overall uncertainty regarding what new trade deals the UK could strike and on what terms. It was a vote into the unknown, economically speaking.
Did other markets react strongly too?
Yes, beyond the pound's plunge, stock markets around the world initially reacted negatively, falling sharply on the news, though many did recover relatively quickly in the following days and weeks. Conversely, the price of gold, often seen as a safe haven asset during times of turmoil, surged as investors sought refuge from the uncertainty. It undeniably sent ripples across the globe, as the source says.
Why such a global reaction to a UK-EU issue?
Well, partly because London is a major global financial center inextricably linked with markets worldwide, and the UK itself is a significant G7 economy. But also, crucially, because it created a precedent. It raised fundamental questions about the future direction of European integration, potentially emboldening Eurosceptic movements in other EU countries. It demonstrated very starkly that political decisions, even those rooted primarily in domestic sentiment, national identity, and a desire for sovereignty, can have immediate, far-reaching, and often unpredictable economic consequences in our deeply interconnected modern world. It highlighted the potential fragility of political unions and underscored the significant economic consequences that can arise from disintegration, or unintegration, if you like. So if we try to step back now and connect all of these seemingly disparate events, the U.S. subprime crisis, the U.S. fiscal cliff, the Eurozone structural flaws, the Greek debt saga, Cyprus, Brexit, if we connect them all to the bigger picture, what becomes crystal clear, I think, is the profound and undeniable interconnectedness and perhaps the inherent fragility of our modern global financial system.
It really does seem like a complex web.
It absolutely is. Whether it's an inverted financial pyramid built on dodgy mortgages leading to a meltdown in the US, or deeply ingrained structural imbalances within the Eurozone manifesting as a sovereign debt crisis that threatens the whole union, or even a politically driven decision like Brexit, sending shockwaves across markets, it shows that a significant crisis erupting in one part of the world can very quickly send tremors, contagion, and consequences everywhere else.
No economy is an island anymore.
Not in this integrated system. And that's why critical thinking is just so essential in today's world, a world saturated with information, and let's be honest, often misinformation, especially when we're faced with such complex, jargon-filled economic narratives. Understanding not just what happened, but digging deeper to understand why it happened, the underlying causes, the specific policy choices made or not made, and their cascading effects. That's what helps you, our listener, to see the deeper patterns, the connections that shape our present economic reality, and will undoubtedly continue to influence our collective future.
So, thinking about all this, what does it all mean for you, our listener? We've delved deep into these incredibly intricate crises today, peeling back the layers from those unregulated financial derivatives that triggered a global meltdown nearly 2 decades ago, all the way through to the painful multi-decade process of sovereign debt restructuring still impacting Greece, and even the political earthquake of Brexit that reshaped a continent's relationships.
It's a lot to take in.
It is. And as you go about your day, maybe thinking about your own investments, your career plans, or simply making sense of the daily news headlines, perhaps consider how these past events, these crises, these responses, these structural flaws we've discussed might still be subtly, or not so subtly, shaping global economic policies today, influencing international relations, and maybe even impacting your own personal financial landscape in ways you hadn't fully realized.
The echoes continue.
They really do. And it leads to a final, maybe slightly provocative thought. Are we collectively truly learning the right lessons from these intense stress tests on the global economy? Are we adapting our systems, our regulations, our political structures effectively enough to prevent similar, or perhaps even worse, crises in the future? Or, as our source material suggested quite pointedly regarding the U.S. fiscal situation, are some of these fundamental weaknesses, these fiscal cliffs and structural imbalances, merely postponed, papered over, still just waiting in the wings, ready to resurface in new and perhaps even more challenging forms down the road?
It's definitely a question worth pondering. Are we building resilience, or just kicking the can down the road.
Exactly. Something for you to think about as we navigate the economic future together.